So once tech started to bottom, so we saw the downside. This is, all these markets kind of look the same, right? But you have to peel back the layers and kind of get a better understanding of like what each individual, asset class is doing in relation to one another. And that's kind of how you get market signals. I'm giving a lot of game here. I hope you're soaking it in.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Welcome back to another episode of Well Positioned. This is your host, Khayri Graves, back with another one. Don't forget to like, comment, and subscribe to the channel, and that'll keep motivating me to keep posting these and sharing as much value as I possibly can. I've been trading these markets for about 10 years, and I've seen pullbacks. I've seen some downturns, some high volatility moments, a lot of which I got caught on the wrong side of and learned my lessons. My bruises and scratches have healed from those incidences, lost some money, made some money. And that's kind of what I like to do with these videos, is just share some of the hints and signals that the market gives from time to time that allows me to determine a few things about what's going on. And I start to compile all that data together, and I'm able to generate somewhat of a market thesis and hopefully a market strategy or plan that will help me make money in the future. And that's what this channel is about, staying well positioned in markets in particular. So in this video, we're talking about, did the market actually bottom? And so for those of you who've been living under a rock, we recently saw the market pull back roughly 6% from its highs that we saw in early March. And there's some speculation on what may have caused that. I think the fact that the market had to digest the notion that the Federal Reserve was not going to be able to cut interest rates as quickly or as soon or as much as they hoped to in the beginning of the year, or as they did in the beginning of the year. And once that kind of became true with some of the inflationary data that started to come out over the last few weeks, the markets had to take a step back and say, hey, look, we may not be getting these rate cuts that we strongly hoped for at the beginning of the year. And as that started to happen, the market has to reprice itself. The market is all based on prices, the price of capital, the price of borrowing, the price of equity. All of those things are constantly priced every day. And what dictates those prices is the economic data that comes out and basically helps traders and investors determine, is this the right price for this particular asset based on what the cost of capital is currently. So that's something you have to keep in mind as you're maneuvering and investing money into markets. Every single day there's a repricing going on, because every single day there's economic activity going on. So we have to think about it in that context. So one of the things I want to do is quickly go through some visuals here and kind of give my spiel on, what I look for after the market pulls back, and what are some of the things I look for to see if the market is actually bottoming, or is this just a quick bounce off of some technical support area and we should expect it to roll back down. Now, my conviction of the recent price action I've seen over the last couple of days, in retrospect to the market pullback we saw over the last couple of weeks, I do believe this is a bottom. This is a temporary market bottom that can actually go to new highs from this particular level. One of the reasons I believe that is because, we do have the speculation about, the Federal Reserve not being able to cut interest rates and that kind of taking out some of the bullishness in the market. But also, too, we have to remember some things on the accounting side of the economy, and that has to do with taxes. Tax day was April 15th, and it's kind of typical around that time when corporations are due to submit their taxes for the previous year. A lot of times, people who made a lot of money, throughout the year in capital gains or profits and whatnot, they have to pay a quite hefty tax bill. And sometimes they may pull from their stock market gains to do that. And especially with the market, it was up over 10% in just a short amount of time. And in 1 quarter of trading, um, that seemed like a pretty good place to grab some short-term liquidity. And if I'm a corporation, I would probably do the same thing. Um, I would probably pull from my current year stock market gains, make some sales, trim, lock in some profits and pay my tax bill for the last year, and keep it moving. That's so I think we saw a bit of that, and I think we saw that on a large scale. So, we have to understand the backdrop of the United States economy is still strong. Fundamentally, even though inflation is impacting um, consumers and corporations negatively, you have the growth on the other side of the inflation that is a positive tailwind that is benefiting consumers and benefiting corporations as well. So growth and inflation both rising at the same time is net bullish for the overall economy and for markets overall. So what we're going to do is we're going to peel into the charts. I want to go over 8 quick things that I looked at when I was looking at price action as the market was quote unquote bottoming. And there's certain things I wanted to see the market do to give me the conviction that, okay, yeah, this is a dip, worth putting some money into. This is a dip worth buying. Of course, nothing can be 100%, but when you start to overlay different conviction points, right? If you just have one conviction point, it doesn't make your argument as strong. If you think about like a court case, right? If you have just mounds and mounds of evidence to the point where the jury has, unreasonable doubt to convict somebody or to say they're guilty or not guilty, amount of evidence makes your argument so much stronger. So that's kind of what I like to do. I like to find amount of evidence that is going to make my argument for the market, saying that the market did bottom, as strong as possible. So that's what we're going to look at. We're going to look at 8 quick things, and I'll get you out of here. I actually want to look at Bitcoin first, and you may be wondering, why would I want to look at why is Bitcoin a part of my layer of evidence, if you will, when it comes to identifying, did the market bottom? And one of the reasons I've pretty much come to the conclusion, I've been around in markets almost as long as Bitcoin has been around, almost. And from what I've noticed with Bitcoin tends to rise when liquidity in the overall system is generally robust. And also, Bitcoin can also be used as a risk appetite indicator. Try to say that 3 times fast. So when I say a risk appetite indicator, Bitcoin is typically a very risky asset. And we see, all the highs and lows that it has had over the years. And so to me, when I saw this market have a pullback, in fact, Bitcoin started its pullback in early March as opposed to the stock market kind of topped out in late March. So Bitcoin started to signal to investors that, hey, I'm not as, greedy for risk right now. And because it didn't really make a new high, that was kind of our first indicator. But, you know, it's just a piece of the puzzle. But one thing I did see as the market started to bottom, I saw Bitcoin bottoming before everything else. In fact, one thing I was hoping to see was that as the market was going down, was Bitcoin going to act like a hedge against the market? Like as the market was going down, was Bitcoin going to finally be the asset that everybody wanted it to be, which was a a hedge on inflation or a hedge on this and hedge on that? And the answer is no. Bitcoin has not been a hedge against anything. But we didn't see Bitcoin fall completely apart. So this was my signal one. We saw it kind of come down, catch its feet pretty early in the game, almost before some of the other indexes. And that let me know, like, hey, there's still some risk appetite out there. The next thing I want to look at is two indexes, in fact. But we're going to start with the first one, which is the Dow Jones transportation average. And this one is important because what the Dow Jones transportation average tells me is that, it doesn't allow markets to rip so far without it participating. So one of the things I was looking at when I look at the Dow Jones transportation averages, I see that during the time that the S&P 500 was ripping to the upside, right? So if you look at a year to date of the S&P 500, we saw that it was ripping, start of the year is right here, ripped higher, going up like 10% or so, pretty much topped out in April. But at the same time, the Dow Jones transportation average was pretty much sideways during that whole time, right? Like pretty choppy. It had some periods of going positive, periods of going negative. But once we took out the lows that we saw in January and started to get close to them, that was a pretty bearish sign. And I one of the things I drew a line on is at the start of the year, the starting point, which is where this red line is. One of the things I would like to see is that I want to see the Dow Jones transports start to get closer to being positive in order to give overall markets the green light to continue to move higher. I don't need the Dow Jones transport average to outperform, but it can't underperform so much to the point that there's this huge divergence between the S&P 500 or the Dow Jones index or the NASDAQ and then the Dow Jones transportation average. So you have different, different indexes that kind of highlight different things within the economy. Another one is going to be the Russell 2000. The best way to think about these indexes, the Russell 2000 and the Dow Jones transports, I look at them as like the little brother indexes to the bigger brother. So you have, the S&P 500, you have the Dow Jones index, and you have the NASDAQ, and you have the NASDAQ index. So those are the three like big main indexes that most people know. They get the most headline news. They are the largest market cap indexes across the board, pretty much in the world. But a lot of people often forget about the Russell 2000, which I've talked about numerous times in my videos, and people also forget about the Dow Jones transports. And those are important because if you think about it from an economic or an economy large scale standpoint, like the Russell 2000 signifies the 2000 companies within, the small cap companies. It kind of represents middle America or small business America, right? And most of their profits come from domestic enterprise, meaning like they don't really have a lot of overseas market share. Typically, you find that in S&P 500 companies, which are more international, multinational companies, and there's only 500 of them compared to 2,000. So us as U.S. consumers, our health within our borders from an economic standpoint is actually mostly represented more in the Russell 2000 as opposed to the S&P 500, because the S&P 500 represents these companies that have such a wide spread reach and gathers profits from all over the world, not just from the United States, even though they are United States based companies. So if we're starting to see the Russell 2000 and it's deviating so much from the overall market, and which we kind of saw similar to the Dow Jones transportations, that if our starting point was here for the year and we had some positive moments and then we start to go negative, but at the same time we see the NASDAQ and the S&P 500 rip into the upside, we kind of have to take a step back and say, this divergence can't continue for too much longer. So when we're talking about a market bottom, I'm looking for those to actually bottom first before the S&P 500. And that's exactly what I saw. And not only do I want to see them bottom first, I want to see them bounce off a low harder than the other assets. And that's exactly what we saw with the Russell 2000. So if we're looking at, a low from its bottom, it's now up 3.5% from that. Same thing with the Dow Jones Transports. It found its bottom, rallied about 3.5%. Good signals. Now let's look at S&P 500. When the S&P 500 found its bottom, rallied about 2%. So good. So now what we're seeing is that the Russell 2000 and the Dow Jones Transports not only bottomed first, but when it did bottom and had a stronger bounce to the upside than the S&P 500 and even the NASDAQ. So we look at the triple Qs, kind of looking at the same thing. So bottom somewhere around here and went up about. So this is a little overnight move, so we're gonna exclude that. But just to the close of today, Tuesday, April 23rd, 3%. So NASDAQ kind of found a nice upside toward the end of the day today, mainly off of some earnings that took place in tech. But nevertheless, the point I'm trying to make is that I never want to see the IWM or the Russell 2000 and the Dow Jones Transports deviate too far from the other indexes to the upside and the downside. So when we're looking at a market bottom, we can also look at a market top in a similar way. But it's kind of hard to pinpoint from a market top standpoint because things can extend longer than, we're prepared to make a trade on. But with this, we see things kind of all bottom at the same time, right? That's just the nature of the market. So we have to have the understanding that, okay, well, what do I want to see bottom with strength first and the strongest? That's going to give me, a piece of evidence on top of the evidence pile that we're compiling here. Next point, gold. As the market started to slide and then recover, one thing I didn't want to see, I didn't want to see gold participate in the recovery to the upside, right? Gold kind of started to break and fall when the rest of the other markets fell, and that was pretty typical. One of the things is we saw interest rates shoot a lot higher, right? And that kind of just, when interest rates go up, that makes the cost of everything, right? Just the cost of money in general, the cost of the dollar go up. So that's going to force all assets in general to reprice in a certain way, and typically to the downside, especially in a move that's kind of really strong and really fast. So when gold cracked to the downside along with the other markets and then started to bottom with the other markets, I was okay with that. But one thing I didn't want to see gold bottom and then rally hard with the other assets. I kind of wanted to see gold chill out for a little bit. And that's exactly what we saw. We saw gold find a little bounce, but it was maybe 1% or so off its bottom low along with the rest of the market. So seeing gold underperform is kind of a signal to say, investors are not, rushing to any safety or safe haven assets, even though the market has quote unquote bounce. It's actually rushing into risk assets like the Russell 2000, the Dow Jones Transports, the NASDAQ. So those are all good signs. Like, okay, this market is finding some footing and money is flowing into the assets that I want to see. Let's look at another piece of the puzzle. Let's look at the 10-year Treasury note futures. Actually, let's look at not the 10-year Treasury note. Let's look at the Treasury bond futures, and mainly because I drew this little trend line that we see here, and we see that bond prices in general have been falling and falling and falling all year, similar to what we saw in the year before last, not 2013, but in 2022. We saw yields shoot higher, bond prices are falling, and those who are owning bonds or traditional bonds in their portfolio are getting pretty much killed, this whole year. That's why you got to pick up the book, One Small Tweak, learn about a better bond to fit into that beautiful 60-40 portfolio, learn how to set that portfolio up.
and the best way to make the most amount of wealth possible. Moving on. So what I was seeing here, and one of the pieces of evidence that we're compiling to figure out if the market has bottomed, we saw that rates, okay, so you have to look at bonds inverse to interest rates. So if bond prices go down, that means interest rates are going up. Almost, it's a pretty much inversely correlated asset understanding. So when we see, this trend line that I drew, is we saw that bond prices started to hit this trend line, and it kind of gave, not saying that the trend line caused it, but the trend line is an indicator of how investors are moving prices within a particular asset, and they found some footing along the bottom of this trend line, and that kind of, for whatever reason, caused interest rates to at least stop going higher for a little bit. It caused bond prices to stop going lower for a little bit. And what we see here is that, the market, remember, we're still looking at the same time frame. The market bottomed, not this particular market, but the indexes, the stock indexes bottomed around this time. And we see that bond prices have kind of traded sideways and caught its footing a little bit. And I kind of like to see that. I want to see bonds just kind of have a low volatility period for a moment and allow risk assets to not only just go higher, but just catch their footing, allow investors to digest some of the earnings that are coming up and whatnot. So this was just another small piece of the puzzle, just seeing bond prices in general just kind of cool the heck out after this volatile, downside action, just chop sideways for a little bit, let the rest of the market kind of take in some of this new repricing. Next piece, let's look at the SMH, which is the semiconductor ETF. So once tech started to bottom, so we saw the downside. This is, all these markets kind of look the same, right? But you have to peel back the layers and kind of get a better understanding of like what each individual, asset class is doing in relation to one another. And that's kind of how you get market signals. I'm giving a lot of game here. I hope you're soaking it in. So when we see tech bottom, like the NASDAQ in particular bottom, one thing I want to see is that these more cyclical part of technology, which would be like semiconductor ETFs, your NVIDIAs, your AMDs, your Broadcoms, right? Your Qualcomms, all of these chip, names, semiconductor chip names. I want to see them have some strength once the NASDAQ finally decides it's ready to stop going down, right? And I wanted to see it have more strength on a percentage basis from bottom to top than the overall NASDAQ, and eventually then the overall, other indexes comparatively. So let's look at the price action we see here with semis. Yeah, beautiful. So what we're seeing here is we're seeing that semis bottomed along with the rest of the market, but damn near up almost 5% off its lows, right? So that's a nice strong move that says that, some of the more riskier cyclical part of the market is actually one of the outperformers once you peel back the layers, right? We saw that the Russell 2000. So we're going to do a little recap of what we got so far before I continue. We saw the Russell 2000 and the Dow Jones transports kind of give us cover to say, hey, we're bottoming. We're not going to diverge too far from the overall market. We're going to bounce and rip to the upside. Now the S&P 500, the NASDAQ, and the Dow Jones index can follow along. Now within the NASDAQ, we see that the semis are participating hard to the upside. Gold chilled out, rates have cooled down, Bitcoin, didn't fall off a cliff. All right, so we're starting to put together our court case and presenting it to the jury like, hey, I think the market is bottom. Let's see if we have any more evidence. So let's see if we can compile more evidence into our court case, right? So looking at the S&P 500 index, one of the things I like to see is just a quick check to see where we are on a longer time frame chart, like a weekly chart that I have pulled up here. One of the things I like to see is, did the S&P 500 check back in with its moving averages? So we have a longer term moving average that it checks in with maybe every couple of years, right? It deviates from it from a long period of time, but you like to see it kind of check back in with it to make sure like, hey, I'm not getting too far
over my skis here. Like yes, I'm ripping higher, as we see the S&P 500 has been doing for, years and years, but it doesn't do it without checking back in, taking a cool down and saying, hey, I'm going to revert back to the mean and allow price to at least find some average levels over a period of time. And that's simply all the moving average is just a calculation of average price across a time period. So we see it hit its 20-period moving average, bounce right off of it. Beautiful. Good enough for me. One last thing. It was funny because I had set an alert and I got really busy with life, and I set an alert on the S&P 500 a few weeks ago, and I was like, you know, there's going to come a time period, throughout the next few weeks. And I was saying this a few weeks ago. I was like, there's going to come a time period in the next few weeks where I may not be able to pay too much attention to the market. But I'm going to set an alert because I do want to know if the market hits this point, I'm a buyer. And I said that to myself, like way before the market would, like the market was actually ripping higher when I was saying this to myself. And I said, let me just set an alert and kind of ignore my investments for a little bit, which I do from time to time, just to kind of pull my head out of the sand and deal with real life. And then I kind of step back in and look at some of the technical stuff. And I was like, yeah, if the market pulls back, if it pulls back to this point, I would love it, and I would be a buyer at this point. And when I started to see the market pull back and started to see some of these red days, I was like, yeah, this thing's not going to come all the way down here. There's no way. And within like a few days, boom, it hit this level. I got the alert, and obviously the alert is gone now, so I have no proof of this is the spot I was actually looking at. But this was a glaring spot for the S&P 500 to kind of pull back to. Why? Because we see this gap here, right? Look, if you look where my arrow is, like we see this gap going on between what was this, between February 21st and February 22nd. The market had a huge gap up to the upside and then continued to take off higher and higher. And one of the things that markets like to do from a technical standpoint is close price gaps and fill price gaps with intraday price action. And that's exactly what we saw. The market pulled back, filled the gap with intraday price action, right? So the price action took place during the trading day as it was closing and filling the gap. The gap was right here, and boom, right where the market bottomed. And then, so once I saw that happen, I was like, okay, this is a potential area that the market could bottom. Now I want to see these other signals that I spoke about earlier. I want to see these other signals come into play. If this is a true bottom, because I was already eyeing up that level on the S&P 500, but I want the other indexes, right? I want the other market signals to tell me how viable of a dip this bottom is. And, obviously this is the whole point of the video. We're gaining that evidence and we're gaining that information. Last but certainly not least, actually two more things and then we're out. Okay, so here's the other thing. Expect a move. Look at this chart here. So we're talking about expect a move, and I'm particularly looking at the S&P 500 again, right? Trying to get more signals. One thing we saw when it came to the expected move was that we had an overshoot of the expected move right before the market topped. And this was very interesting to me because we saw the market, go up and up and up, but for the most part, it was staying within these, weekly expected movement levels. And we see the green is high, red is low. And so market action is staying within it. And that's just a standard deviation calculation that the options market prices out at the beginning of the week. And once we saw, this was the week of the 19th of March, boom, we saw this huge breach of the expected move for the week. And we saw price make a true standard deviation move outside of that. And then after that, the market topped out and just got crazy and then started to just rip lower and lower and lower. What did we see last week? We saw a huge breach, almost a 2 standard deviation move outside of the market to the downside, and almost signaling like the market just flushed out the market just flushed out all of the sellers. Anybody who wanted to sell was just selling and puking up their positions, and it was a bloodbath kind of the last few days of last week. And I was kind of watching some of it intraday, and I was like, man, this is just relentless selling. We saw like Nvidia down 10%. We saw the Nasdaq was down, almost 3% one of the days, or 2% one of the days. And those were like big moves for large, indexes and large stocks like that. I had a lot of stocks that were just completely, getting killed. The expected move situation, like, yeah, we see a breach to the standard deviation move, and now the market's kind of snap back into, reverting to the mean, as we talk about, kind of like it did here. It snapped up higher and then it kind of reverted back and then overshot to the downside. So just another signal that I like to look at. Last but not least, let's look at some economic data that came out. It's only, Tuesday, April 23rd, but we saw something on Monday that was pretty important. The Chicago Fed National Activity Index. And I had to read up on it because I didn't know too much about it. But basically, it's saying is that it's a gauge. It's designed to gauge overall economic activity and related inflationary pressure. And whatever they're calculating, they're kind of trying to calculate like an overall, market, activity over the last. I guess this is probably month over month or maybe year over year. I'm not sure what this is. I'm not sure the time frame they're using. This might be like a yearly thing, but nevertheless, it's an important piece of data that comes out. Not super important, but kind of important. But the thing that was most important was that it overshot to the positive side. So this is showing like there's strength, not only from an economic activity, but inflation is not. I think what this index is trying to say is that inflation is not impacting overall national activity, economic activity too much, and that they expected a 0.09 forecast and they got a 1.5. So whatever that means, you can kind of look further into the index, but we see that we're starting to catch a little bit of a trend in a positive area. Last but not least, Tuesday, so we had some stuff come out that it's caught my eye. New home sales came out better than forecasted positively. That was good. New home sales month over month, they expected a 2.7% and we got an 8.8%. Like that's good stuff when we're talking about, the consumer, the health of consumer, like purchasing homes. Like a lot of that fuels and stimulates economic growth and activity. So for you to be bearish right now from a fundamental standpoint, you're looking at the wrong data. And I try to build my story off of the data. I try to build my story off of what's going on in the markets, listening to the markets, listening to the data, and then putting the right investments and positions and plays within my portfolio. So that's all I got, man. We'll be back with another one. Take care.